Imagine watching two investors start on the same day with the same amount of money and the same opportunities and the same goals. Yet 20 years later, one is financially free while the other is still chasing returns. The difference is not intelligence, it's not luck, but patience. The ability to let time do the heavy lifting while everyone else tries to get rich fast. Most people assume investing success comes from finding the perfect stock or the timing market correctly, but history shows that the real winners are not the ones who move the fastest. They're the ones who stay invested the longest without panicking when things look uncertain. And this idea goes against human instinct because your brains are wired for immediate feedback and quick rewards, which makes slow investing feel uncomfortable even when it is mathematically superior over long periods of time. The truth is that compounding works like gravity in finance. It seems weak in the beginning, but becomes incredibly powerful as time increases. And investors who give their money enough time allow small, consistent gains to turn into massive wealth without needing extraordinary decisions. And think about it like planting a tree. You do not dig it up every week to check if it's growing fast enough. You water it, protect it, and let it grow underground roots before you ever even see real visible progress above the surface. Slow investing works the same way. It feels boring in the short term because there's no constant excitement, no daily breakthroughs, and no dramatic headlines. But that boredom is actually a sign you're doing something right. Most investors who fail are not losing because their strategy is terrible. They're losing because they abandoned good strategies too early. And usually, right before those strategies would have started working, market volatility is not a signal to stop investing. This simple. It's simply the price you pay for high long-term returns. And those who understand this treat downturns as opportunities rather than threats. The investors who succeed are not the ones who predict every move correctly, but the ones who stay consistent through every emotional cycle of fear and greed that the market creates. Instead of chasing fast money, slow investors, they focus on owning quality assets, reinvesting the returns and letting time reduce the impact of mistakes and volatility. This approach requires discipline because it's emotionally harder to do nothing than to constantly trade. But nothing in the right place is often the most powerful financial move you can make over time. Slow investing filters out the noise, reduces the cost mistakes, and allows your portfolio to reflect real economic growth instead of short term speculation while others jump from trend to trend. And slow investors build a foundation that does not collapse when the hype fades or the market shifts unexpectedly. The biggest advantage of slow investing is not higher returns alone, but reducing the emotional stress because you are no longer reacting to every headline or price swing. Or freedom in investing, it does not come from constant action. It comes from intelligence in action, guided by a long-term strategy that respects the compounding slow interest investing too. It's not about doing less for the sake of it. It's about doing what matters and ignoring everything that does not contribute to the long-term growth. If you can master patience in investing, you gain an edge that no algorithm or trending strategy can replicate because time itself becomes your greatest ally. Most people underestimate how powerful avoiding mistakes can be, yet in investing, not losing money repeatedly often matters more than trying to win big in every short-term cycle. Slow investing also allows you to take advantage of the global economic growth without needing to predict which sector or company will dominate next year. Instead of reacting to the noise, you stay anchored to a strategy that compounds wealth through dividends, reinvestment, and broad market exposure. And this removes the pressure of constant decision making and replaces it with a system that works quietly in the background while you focus on your life. And the irony is that the most aggressively people try to get rich quickly, the more likely they are to take risks and destroy their progress. Slow investing protects you from yourself and from emotional decisions that look smart in the moment but are disastrous over time, and forces humility, and reminding you that you do not need to outsmart the market. You only need to stay in it long enough to let it work. And every major financial success story that looks simple in the hindsight was actually built on years of patience, not constant activity. And the people who stay consistent during boring periods are the same ones who benefit the most when compounding accelerates. And that acceleration does not feel dramatic at first, but over decades, it becomes the difference between financial comfort and financial freedom. Slow investing is ultimately about trusting a process that has worked across generations despite constant attempts to reinvent it. It is about recognizing that wealth is not built through speed, but through endurance and consistency over long periods of uncertainty. And when you finally understand this, you stop trying to beat the market every day, and you start focusing on simply staying in the game. You begin to realize that most financial stress comes not from investing itself, but from constant comparison to others who appear to be moving faster. Slower investors remove the comparison by focusing on their own timeline, not the noise of social media or that short-term market chatter. This mental shift is what separates reactive investors from strategic ones, because strategy requires emotional distance from daily fluctuations. The market will always reward patience in ways that feel invisible day to day, but undeniable over long horizons. If you look closely at any major index over time, you will see that most of its gains come from a negatively small number of strong upward periods that challenges is not identity. Those periods in advance, but simply staying invested through all the uncomfortable periods in between. That is why slow investing is less about prediction and more about participation in the long term growth of productive economies. You're not trying to outguess every move. You are simply aligning yourself with the general direction of human progress and innovation over time. And that alignment becomes powerful enough to outperform most active strategies without requiring constant effort or stress. The real secret is that slow investing is not about doing nothing. It's about doing the right thing for long enough. The time and compounding do what human effort alone never could. And this is what builds lasting wealth. Thanks for watching today's video. If you found value in today's video, please subscribe. We're looking to build this channel, and without that subscription base, we just can't do it. And I want to see you on the next one, because we're going to be here tomorrow. I want you to be on part of the team. We're going to make this channel hopefully a great community, and I'd love for you to be a part of it. So if you would subscribe, I'd appreciate it. Thanks for watching, and we'll see you guys on the next one.